Hi everyone, it's Russell here from Enhanced Asset Management. Really hope this video finds you well today. Obviously, 1st of April as I record this, end of the month, so we thought we'd provide a quick video update on what we're currently seeing. Now, most of you would have already noticed that financial market volatility has increased since the Trump team has come into administration. VTS, as I show here, which is effectively the S&P 500, has fallen about 9%. So it's in uh, market correction territory. Now, just remember that these corrections happen on average once every 2 years. So we've just had 2 years of 20 to 25% compound annual market returns. So and towards the back end of last year, we had noted that we were somewhat concerned around the performance of the US market being concentrated in such a small number of large cap or mega caps in this case. So on that basis, we had an investment committee and we had decided to shift out around 10 to 15% of your international exposure into small caps. And as noted from this chart in purple, you can see that's provided some sort of downside protection in this period. We say it's at the moment what we're seeing is of garden variety correction, and we'll focus here on credit spreads, which is usually the best canary in the coal mine of all the economic indicators out there. In terms of this correction going not from 10%, being something more meaningful, 30, 40, 50%. And we're just not seeing that at the moment. We can see here COVID, we had a big increase in credit spreads back in '09. Also GFC, a big increase. Now, these were the big market events. This is the current period here where we're seeing credit spreads being more normal in their historic range. So we're not seeing evidence yet of any sort of massive level of financial distress within markets. There's been a lot of headlines about recessions, potential downturns, but we're just not seeing any fundamental deterioration in credit quality here, which would set off, an even bigger fall in asset prices. So um, I guess to understand what's happening at the moment, we have to go back to Trump's first term in office, and we know that the market's performed exceptionally well over that period, with the VTS, for example, being up 63% over the 4 years. So, if anyone's saying that Trump doesn't understand financial markets, he doesn't understand what he's doing today, I think we just need to go back. We have the benefit of hindsight here and understand what he has achieved. And what he achieved was a very balanced outcome in terms of policies. In his first term, we had some pretty significant corporate and individual tax cuts, which is stimulatory. We also had numerous regulations being rolled back within the US economy. Again, that was stimulatory because businesses felt more comfortable of going out there and investing and employing. But on the same token, we also had the negative in that we had what we're seeing today in tariffs and trade wars, which is obviously restrictive. But on balance, when we think about these three policies together, because they were more of a more stimulatory outcome, we saw financial markets and the US economy do very well over this period. Now that's in a little bit of shade compared to what he's been doing in the first period, a little period since he's been in office, and the Trump team hasn't been balanced. Well, at least they haven't communicated a balanced approach early on. And in saying that, the first thing we're seeing in terms of policies, again, we're seeing the tariffs come out. It's designed to reorder the global trade system to the benefit of the US economy. They say this is aimed, obviously, at bringing back manufacturing jobs to the US. That's what we're currently seeing. And we're also seeing Doge, which is Elon Musk's baby, which is focused on really getting in there, like he's done with a lot of these private businesses, cutting waste, fraud, and abuse from the government. It's really aimed at getting the government back to a more stable and balanced position. We're also seeing that at the moment. So them on their own are very, very restrictive towards the US economy. They're financially restrictive. And what we're seeing is uncertainty around that, which is creating the volatility, which is leading to the garden variety correction we're seeing. Now, it's taken us quite a long time to unpick this because they haven't been open in terms of communication. We've had to really dig through our research channels to kind of understand what they may be thinking. So this is just our view, but it seems like there's going to be some big policy announcements coming in terms of government banking regulations. And it's the view of many in the current administration that these have been grossly overdone since the GFC. Now, we haven't seen this yet, but if this is enacted and we do see some rollbacks here, this might be one of the biggest events to happen in the last 20 years in terms of the US economy. it'll be a huge net positive, leading to a broad surge of investment growth, really opening the corset, so to speak, and allowing businesses to borrow more, to invest, to have the confidence to go out there and employ people. So this will happen over time. It hasn't been announced yet, but that's what we see as it potentially coming. What we see that the Trump government is trying to do, so at the same time, they de-lever the government via Doge, loosen regulations, and this will allow the private sector to re-lever, so effectively take over what they've taken out of the government. All those government jobs that have been shed will be employed more by the private sector, and they were able to do that not only from the regulation rollback and broad-scale business investment, but also because of tariff protection and manufacturing, et cetera, coming back onshore and creating the jobs to re-employ those people. This is just going to take time. It's a big moving beast. The US economy is massive. So it's not going to be done in the first 8 weeks. It's going to take probably his whole administration, which still has 200 weeks to go. So they do need time. But if this is able to be achieved, it'll be a fantastic legacy for US government, the current new administration team, and also the US economy. And then, ipso, it'll be fantastic for the US financial markets. Now, just expect some more volatility potentially coming up on April 2nd, which is Wednesday or Thursday in the US. We have Liberation Day obviously coming up. This is when we're going to hear more from the Trump team and what they're thinking, particularly around tariffs. So again, it's more of the restrictive probably view at the moment before we get to a more balanced view. So we do expect some more volatility in financial markets. Now, as I show here, when markets turn negative, particularly in the short term, it's very normal to want to narrow your view. The end of the world's coming. The press is very negative. It's always talking about this stock's down, that stock's down, this market's down. Trump's being very negative. Trade war over here, tariff over there. But remember to zoom out. We've had wars. We've had the GFC. We've had tariffs before. We've had COVID, all of which were trouble for markets. Some of those periods, the markets were down 30, 40, 50%. We're down 9 at the moment, to put that in perspective. So despite all these challenges, this is a 20-year graph of the US stock market measured by VTS. Again, it's the S&P 500 equivalent. It's up 662%. Trying to dance in and out over that period, it's very, very hard. First decision you've got to make is, I'm freaking out a little bit. I need to sell. I need to protect my capital. Then you get all emotional. You don't reinvest at the right time, and obviously, it's incredibly hard to do. And there's a litany of financial publications and reports that says it too. So, what we just try to do, we understand that everyone's expectation is the market is going to be a smooth ride. It is anything but. We have a time-proven investment strategy that we know that works. We've been through a lot already with what in the last 5 to 6 years that we've been together. But it's just more important to stay the course, let time-effective compounding do its work, tax-effective compounding do its work. And we think in 5, 10, 15 years, we won't even be talking about this. We'll be talking about some of that issue. So that was just a little bit of update from me. Again, I hope it finds you well. If you have any questions or comments, please reach out to either Jeremy, myself, or Bowen. Always here to answer any questions you may have. But that's all for me today. Please reach out if you need. Thank you.